Most people think markets move because of news, earnings, or economic data. But those are just surface-level explanations. Underneath all of it, there is a deeper force that drives the biggest moves in markets. That force is liquidity. Liquidity is simply the availability of money and credit in the financial system. When liquidity is abundant, money is easy to access, easy to borrow, and easy to deploy. When liquidity is tight, money becomes scarce, harder to obtain, and harder to move. This is why liquidity matters so much. Markets are not just driven by what things are worth. They are driven by how much money is available to chase those assets. More liquidity means more buying power. Less liquidity means less support for prices. When liquidity increases, it flows into the system. Investors take on more risk. Capital moves into stocks, crypto, real estate, and other assets. Prices rise not just because fundamentals improve, but because there is simply more money chasing returns. When liquidity is removed, the opposite happens. Risk appetite falls. Capital pulls back. Markets begin to struggle, even if the underlying economy has not changed much. This is why markets can fall even without bad news. This is also why liquidity and interest rates are connected. Interest rates influence the cost of money, but liquidity determines how much money is actually moving through the system. One shapes the price of money. The other shapes the flow of money. The Federal Reserve plays a key role in this process. Through its balance sheet, lending facilities, and policy tools, it can add liquidity into the system or remove it. This is where concepts like quantitative easing and tightening come into play. But liquidity does not only come from the Fed, it also comes from banks, credit creation, and the broader financial system. That is why tracking liquidity is more complex than just watching interest rates or headlines. Here is the key insight. Markets tend to rise when liquidity is expanding, and struggle when liquidity is contracting. This relationship is not perfect, but over time, it explains many of the biggest trends across assets. This is also why markets sometimes move in ways that seem disconnected from reality. Good news does not always push markets higher, and bad news does not always push them lower. Liquidity conditions often matter more than the headlines. If you understand liquidity, you start to see markets differently. You stop reacting to every piece of news and start paying attention to the underlying flow of money. That is where the real signals are. So while interest rates sit at the center of policy, liquidity sits at the center of market behavior. It is the hidden driver behind many of the moves that seem confusing on the surface. But this raises the next question. If liquidity is so important, how exactly does the Fed create it or remove it? What are the actual mechanisms behind it? That is what we break down next. Because once you understand how the Fed controls liquidity, you start to understand where markets might go next.